the roll call, and then we'll catch Stacy when she gets logged in.
Okay, thank you, Mr. Vice Chair. Margaret Brown?
Aye.
Rob Fechner?
Good afternoon.
Henry Jones?
Here.
Matthew Seha for Fiona Moss?
Here.
Lisa Middleton?
Present.
David Miller?
Here.
Elena Ortega?
Here.
Jason Perez?
Here.
Ramon Rubalcava?
Here.
Shonda Wesley?
Here.
Betty Yee?
Here.
And I don't see Stacy Oliveris as of yet, Mr. Vice Chair.
Okay, well, hopefully she will be on shortly. Let's move ahead with the approval of the November 16th, 2020 Investment Committee timed agenda.
Move approval. Second.
Okay, moved and seconded. Any discussion? Okay, I'll call for the question. Ms. Hopper, if you would call the roll.
Margaret Brown?
Aye.
Rob Fechner?
Aye.
Henry Jones?
Aye.
Matthew Seha for Fiona Ma?
Aye.
Lisa Middleton?
Aye.
David Miller?
Aye.
Stacy Oliveris? Elena Ortega?
Aye.
Jason Perez? Ramon Rubalcava?
Aye.
Shonda Wesley?
Aye.
Betty Yee?
Aye.
Mr. Vice Chair, I have all ayes. Margaret Brown making the motion, Henry Jones seconding it.
Right. So on to item 4, executive report. Mr. Bienvenu.
Yes. Thank you, Mr. Vice Chair. Good afternoon, and good afternoon, members of the Investment Committee. It's a pleasure to be with you here again today on what is amazingly our actual last Investment Committee of 2020. I can't believe that we are already approaching the holidays and that 2021 is almost upon us. I actually feel like I just got used to dating things 2020 and now have to adjust to 2021. It's also amazing to me that we've done every Investment Committee this year in this virtual environment. It certainly seems to have gone fast, but it's been 8 months of this remote working. And it seems like just yesterday that we completed this pivot from that kind of minimal remote work to 100% remote work when the pandemic broke out. At that time, of course, our number one priority was ensuring the health and safety of our team members, while also very carefully minding the portfolio, maintaining productivity and risk control, and protecting the sustainability of the fund on behalf of our nearly 2 million members. These, of course, remain our critical priorities today, and I continue to just be really proud and appreciative of the work of this excellent team. And with this being the time of year to be especially thankful, I also want to take a moment to note how extremely appreciative I am and we are of you, the board, and your strong and continued support as we navigate the challenges that we face together. And while it's nice to take a moment to be thankful, I can assure you that we won't let that thankfulness translate into complacency. We remain focused on the work to be done to best position the portfolio for the long term and executing on our agreed CalPERS-owned investment strategy, which includes, of course, the centralized management of the portfolio positioning, allocation, leverage, and liquidity, preparing for and navigating through our upcoming ALM cycle, and then continuing to build on our capabilities to further deploy assets into private markets, where we believe that the trade-off between return and risk is a better trade-off. And as long as we're on the topic of being thankful, I would like to take a moment of personal privilege to acknowledge and to thank Eric Baggeson, as he is retiring at the end of December, and this will be his last investment committee with us. For me personally, Eric has been not only a boss and a colleague, but also a friend and a mentor, and I'm extremely thankful for what he's done, not only for me, but for this organization. Eric has dedicated more than 16 years of tremendous service to CalPERS and to the investment office. He joined in 2004 as a senior portfolio manager, which is now known as investment director, over the internal equity team within Global Equity. In 2008, he was named the senior investment officer, which is now managing investment director for Global Equity, and in 2013, he moved over to run what is now trust level portfolio management and implementation. And you may recall that Eric also acted as our interim chief investment officer in late 2018. Throughout Eric's time with CalPERS, his leadership and his personal relationships really have been immensely valuable, and he's been a key contributor to the extensive evolution that the investment office has experienced over that time. Many on the team will acknowledge that Eric and I probably disagree as often as we agree, but it's exactly that different and diverse thinking that we have across our entire investment team that makes us stronger and contributes to better investment decision making. So I really just want to pause a moment and to thank Eric for his many years of commitment, creative thinking, energy, and efforts to make this place better day after day. So Eric, thank you. Now, as further evidence of Eric's commitment to CalPERS' success, he graciously agreed to stay on with us as long as necessary to ensure his successor's full integration into our organization and our one team, one fund culture. And that successor was appointed a couple of months ago, and it's Sterling Gunn, who is here with us today and is our new managing investment director for the trust level portfolio management and implementation team. Sterling comes to us with extensive experience. He served as a senior vice president and co-head of total portfolio strategy at GIC, which manages Singapore's foreign reserves. And he was a vice president and head of quantitative research for the Canadian Pension Plan, or CPPIB, among other experience. Sterling played significant roles in designing and implementing a total fund approach at both CPPIB and GIC, and he deeply understands the numerous factors that CalPERS must consider while constructing and managing our portfolio. So a hearty welcome to Sterling, and one more time, a huge thank you and note of gratitude and congratulations to our friend and colleague, Eric Magnuson, on his retirement. And now I'd like to turn our focus to a couple of highlights from the quarterly update on performance and risk, which is in the information consent items, item 6C. Of course, the primary purpose of this investment committee is to provide oversight to the management of the portfolio, so I thought I'd spend a few minutes giving an overview. For the period ending September 30th, the total asset value of the PERF is approximately $408 billion and approximately $22 billion for the affiliates, for $430 billion in total, with the affiliates growing quickly, of course. And for the PERF, that keeps us at just over 70% funded or 30% underfunded. For the 1, 3, 5, and 10-year performance numbers, the PERF's absolute return is actually right at or above 7%, which underscores how dependent performance measurement can be to the time period used. As you may recall, many of the numbers were below 7% at the end of June. This also reinforces our need to stay focused on the positioning of the portfolio and the resultant performance over the very long term, because long term is the nature of our liabilities. Now, on a relative basis, the PERF has underperformed our benchmark in all time periods, which speaks to our need to be and to really stay laser focused on what we're here for, which is to manage this large and complex portfolio to generate positive performance. We did outperform last fiscal year, which was a good outcome, but a portion of that excess return came from measurement timing in the private markets, and it's only a one-year performance number where ours is a very long-term horizon. So your investment team is staying laser focused on the portfolio and the performance, and we greatly appreciate your support in helping us remain that way. Regarding portfolio positioning, we have the portfolio allocated really as we want in the public markets, but in the private markets, and specifically private equity, we remain underweight. This is the reason that deployment in private markets remains an area of critical emphasis and attention for us. As an offset to our underweights to private equity and to real assets, we are overweight public equity. And while the report reflects a slight underweight to the fixed income asset class, that is offset by fixed income exposures at the plan level. Regarding some of the risk metrics for the portfolio, total forecasted volatility remains at 11.5%, with forecasted tracking error at 1.1%, and 0.3% for what we'll call our actionable tracking error for the portfolio. And we'll have more on these risk measures in item 8A coming up. The portfolio remains highly liquid, with liquidity coverage ratios reflecting plenty of coverage across all forecasted timeframes and scenarios, and with more than $15 billion in balance sheet overnight liquidity. These risk metrics speak to the need for us to consistently be intentional in where and how we take investment risk. We do know that getting to 7% won't happen without taking risk. So the key is to take risks we deem to be prudent and that we believe will be compensated for. And with that, I'll move to closing with an overview of today's agenda. We lead off, first of all, with 2 action items. First, Dawn Moulds and Scott Tarondo will join Christine Reese and Sterling Gunn to present a recommendation on the discount rate for the long-term care fund. Next, Ann Simpson, our newly appointed Managing Investment Director of Board Governance and Sustainability, will look to close the loop on the Investment Committee delegation. And I'd be remiss, candidly, if I didn't also take this opportunity to congratulate Ann. We certainly want to thank Eric and to welcome Sterling, but a sincere and heartfelt congratulations and thank you are also due to Ann Simpson for her much-deserved promotion to Managing Investment Director of Board Governance and Sustainability and her more than 11 years of dedicated service to this organization. After the action items, we move to our information items, and we'll start with Michael Krim, presenting what is intended to be an educational item on the tracking error risk metric as part of our CalPERS overall investment risk management framework and one of our many guardrails to manage the portfolio's investment risk. Then we have Daniel Ingram joining us from Wilshire Associates to present the annual consultant review of CalPERS divestments as required by CalPERS total fund investment policy. This will be followed by an update from Ann Simpson and Divya Mankikar on CalPERS investment strategy on climate change risk and opportunity. And then in the last information item, we'll hear again from Ann, joined this time by James Andrus on the annual update of the responsible contractor policy. And then finally, we go back to an action item, this one led by Matt Jacobs regarding the pending ownership transition of Wilshire Associates, the board's general pension investment consultant. And that concludes my opening remarks, Mr. Vice Chair. And with that, I'll turn it back to you for any questions or to take us through the agenda.
Yeah, thank you. I have a question from Mr. Jones.
Yeah, thank you, Mr. Vice Chair. It's not a question, it's just a comment. I just want to congratulate Mr. Baggeson and wish him well on his retirement. I know he has provided a number of outstanding professional years to CalPERS, and I know there are a number of times that we really had to lean on him to take the lead in being an interim CIO, an interim managing director over the years, and each time he has stepped up to the plate and delivered on behalf of our 2 million members. So I just wanted to congratulate him on a long career and wish him well, and also welcome Mr. Gunn to our family. Thank you.
Yes, thanks to Mr. Baggeson. Welcome to Mr. Gunn. Congratulations to Ms. Simpson. I'm sure we all share those sentiments. And so at this point, we'll move on. I see no more questions or comments for you, Mr. Bienvenu. And so we'll move. I've got action consent item for approval of the September 14th, 2020 Investment Committee open session meeting minutes.
Mr. Vice Chair, I do show that Stacey Oliveris is now online, so I've marked her as attending.
Okay, thank you. Yeah, I saw her come on board. Great.
Margaret Brown.
Is this on the minutes? No.
Yes, yes, it is.
Abstain. I wasn't here.
Has it been moved? Has it been moved?
Aye.
We need a motion and a second.
Correct, Henry.
So do I have a motion?
Okay, I'll move it.
I second.
Okay, Henry, okay. So now we'll call for the question. If you call the roll, Ms. Hopper.
Margaret Brown.
Abstain.
Rob Tegner.
Aye.
Henry Jones.
Aye.
Matthew Stahoff for Fiona Ma.
Aye.
Lisa Middleton.
Aye.
David Miller.
Aye.
Stacey Oliveris.
Aye.
Elena Ortega.
Aye.
Jason Perez.
Aye.
Ramon Rubacava. Ramon?
Michelle is muted, Ramon.
And Shonda Wesley?
Since I wasn't on the committee, is it appropriate for me to vote on this?
Abstain.
Abstain.
Betty Yee?
Aye.
Mr. Vice Chair, I have Henry Jones making the motion, Stacy Oliver seconding it. I have 9 ayes and 2 abstentions, one from Margaret Brown and the other from Shonda Wesley.
Thank you, Ms. Hopper. Okay, on to item 6, information consent items. Anything that anyone wanted pulled that they may have conveyed to Teresa? Okay, Betty Yee, Ms. Yee.
Thank you, Mr. Vice Chair. I wanted to pull item 6A just for discussion.
Okay, we will do that. Thank you.
Mr. Chair, Mr. Vice
Ms.
Chair?
Brown wants to pull, Ms. Brown,
Yes, 6D. Thank you.
60, the same as Madam Controller, okay. Any others? Okay, let's move on then, Mr. Bienvenu, to 6D, the quarterly update on investment controls.
Mr. Vice Chair, with all the 6s, those are consent for us, so we're happy to take any questions, but we don't have any planned remarks, although I do note that we do have the request to pull the 2 of them.
Okay, I guess I'll go back then first to Controller Yee, for any specific questions.
Yes, thank you, Mr. Vice Chair. Just on item 6A, I know this is the 2021 calendar that shows the 4 regular investment committee meetings beginning in March and then June, September, and November with the special ALM workshop in February. And I just wanted to get clear about the process about additional meetings. In September, I know we had a robust conversation that started in the governance committee about additional meetings. And I just feel it's important for us to have, I mean, after today's meeting, we won't be meeting again until March. And I just think given the flux of the economic conditions that we might want to think about at least just adding a January meeting to level set in the beginning of the new year and leave it to the governance committee to consider the remainder of the calendar for next year.
Yeah, so there was committee direction based on the last discussion, Controller, as you indicated, in coordination with the chair, Teresa Taylor, when we looked at the calendar, you're correct. So you'll have the normal quarterly full investment committee meetings with, the full reporting out of the typical items that you would see. January, we have the board education day as well as the stakeholder forum. Adding an investment committee meeting in February to deal with ALM. That's the largest body of work, I think, for the investment committee for next year. But we could certainly add a market update. We could modify that agenda to whatever topics that the board would like to see. That we'd be completely flexible to that. And then you have your normal quarterly updates thereafter. So that's what, it's too bad that Ms. Taylor is not feeling well, so that she could report out on this as well. But that was the recommendation coming from her. And then the current wording in the governance policy says at least 4 times per year. So at any point in time next year, if the board was feeling that they needed to add an additional meeting for a specific purpose or otherwise, we could certainly get another meeting scheduled.
Okay, and would that be through request of the chair to add a meeting?
Yes.
Okay, so I guess what I'd like to maybe request is that we do build out the time in February, in addition to the special ALM workshop, to just get some updates as we normally would if it were a full investment committee, since that's the first real committee meeting of business in the new year.
Okay. So if there's anything specific you would like to see, certainly let us know as we're building out this agenda. But I think what we were planning is a full AOM update as well as kind of an outlook on the market.
Yep, exactly.
Okay. Yep.
Yeah. Thank you.
Okay, and on to, if your questions are included, Control E. Okay, on to Ms. Brown, your questions for 6D.
Yes, thank you. I'd like to also comment on Ms. E about having more meetings. I recall our last investment committee meeting went 12 hours and I still didn't ask all my questions. So hopefully we won't be doing that in the future. So Mr. Bienvenu, 6D, attachment 1, page 12 of 22. And this is probably going to be a Greg Ruiz question, but I have a question about private markets. You might recall that last quarter, I was asking about capital calls from private equity, but specifically subscription lines, right? If we had seen a lot of those, and Greg had said we didn't know at that point in time. But when I look at page 12 of 22, I see contributions of 567 million, distributions of 463 million, and then I see other changes in market value of 254 million. But I'm just wondering if any of those 567 million in contributions we made, if any of those were capital calls for subscription lines. And the reason I ask is I had read a number of stories in investment publications that said it was becoming a problem, especially after March and the market downturn, that private equity was using subscription lines to increase their bottom line.
Yes, so to your point, Ms. Brown, it's definitely better to get Greg to answer that. He can speak much more closely to the subscription lines both being drawn and then also paid back with capital committed. So let me ask Jared if he could please pull Greg Ruiz into the presenter room so that he can take Ms. Brown's question.
Dan, my guess is he won't have that off the top of his head, and so I'd rather have a more accurate number if he wants to get back to me. Hi, Greg. Greg, I was asking about capital calls for subscription lines. I think I raised this about a quarter ago, and I wasn't concerned about capital calls. I was concerned about the portfolio companies using subscription lines to increase their bottom line. And I'm just wondering if part of that 567 million in contributions, what that was and how much of that was subscription lines, and if we have seen an increase in those numbers.
Yeah. So what we have seen in our portfolio is a large number of our managers now use subscription lines to consolidate their capital calls. So instead of calling capital at the time of each investment, what they may do is consolidate a few capital calls and then call capital 2 or 4 times per year. What they'll do is they will then use the subscription lines to fund the investment and hold the investment on the subscription line for a short period of time until they call the capital from their LPs. So to your question, it is quite common for private equity firms at this point to use subscription lines for that short period of time between when they make an investment and then they call the capital from their LPs, including CalPERS. If the question is specifically what of the 568 million was first put on a subscription line before calling from LPs, you're correct. I would need to look at that specific number.
And I'm more interested in the trend, because the stories I read were about how they were kind of getting out of control, and they were really large. And so I just want to see maybe what the trend for capital calls is. I know you give us this information quarterly, but it's not broken down. So if you wouldn't mind doing that, I don't know if anybody else wants to see that, but I just like to see if it's going to become a problem for us. Does doing these sort of consolidated subscription line ask for requests, does that harm us at all, or does that interfere with our cash flows or anything else like that? Does that harm us at all financially?
Yeah, we routinely assess how much is outstanding on subscription lines, our partner subscription lines, and have a kind of good view into that in the course of our normal monitoring of our portfolio.
Great, that's what I'd like to see. That's it. Thank you.
Okay, thank you, Ms. Brown. I have Mr. Let's see who's next here. Looks like Mr. Jones. I have a question.
Yeah, thank you, Mr. Vice Chair. Yes, it's not a question, it's a comment. Read another story in Buyout magazine this morning where they continue to receive incorrect information about our long-range capital fund 1 LP, where we made a commitment of $1.5 billion. And I provided them the correct information in the past. And I just want to reiterate that this investment was discussed multiple times by the board. In fact, at the board's direction, independent fiduciary counsel was asked to review the potential transaction, to review this exact issue. After discussion, CalPERS moved forward with the opportunity as a customized investment vehicle under the team's delegated authority, not as a Pillar 4 opportunity. We are pleased that our private equity team is successful executing its strategy to steadily and prudently increase private equity investments and can drive returns to achieve our targeted returns. And that is listed in the open session item 6D, attachment 1, page 22, and page 35 of the iPad. So thank you, Mr. Chair.
Okay, thank you, Mr. Jones. I'm not seeing any other questions, so I think we'll move on, Mr. Benvenu, to the action items. It's number 7 action items, long-term care asset allocation and discount rate. So I think we need to bring on Dr. Molds and Mr. Taranto.
Yes, thank you, Mr. Vice Chair. Yeah, Jared, if we could please get Dawn Molds, Scott Taranto, Christine Reese, and Sterling Gunn brought forward into the presenters room, please. And as you say, Mr. Vice Chair, this is the first of our action items. So let's see, I see Christine, I see Dawn. I think we just need Scott and James Gunn. There's Sterling. And here comes Scott Taranto. So I think we're good. This is a cross-team effort with the health team, the actuarial team, and the investment team. So Dawn, I'll turn it over to you to kick us off.
Actually, for open session, I'm going to be starting. Thanks, Don. So good afternoon, Mr. Vice Chair and members of the committee. Christine Reese, CalPERS team member. Today in Investment Committee and tomorrow in the Pension and Health Benefits Committee, you will be hearing about proposed steps that CalPERS team members are recommending to stabilize the CalPERS long-term care program. Over the last several months, we've been working to mitigate challenges facing the program. Today's Investment Committee item focuses on the long-term care fund investment portfolio and a detailed review conducted by the Investment Office with the goal of improving the outlook for long-term expected returns. For today's presentation, we have available for questions and comments Vince Bodnar, a long-term care consultant and partner with the firm Oliver Wyman, with whom we have been working during the last several months, and Tom Toth, your board consultant from Wilshire. Do we have a slide presentation? That I don't see it yet. Thank you. So before we move into the slide presentation, for background, we discussed at the September Investment Committee meeting that there are challenges facing the long-term care investment portfolio. As the sole sources of funding for the long-term care program are policyholder premiums and investment returns, it's important that we explore all options and ideas that could be of benefit to the program. In mid-September, to discover external manager expertise and allocation options, the Investment Office released a comprehensive request for proposal for asset allocation and investment management services for the fund. It was originally anticipated that specific asset allocation options and a recommendation could be brought forward to the Investment Committee at this November meeting. However, due to the size and complexity of the proposals, the full review will be presented at the February 2021 meeting. For today's meeting, the Investment Office is presenting findings in support of the current recommendations for discount rate, level of risk, and asset classes and investment products for the long-term care fund. If we could move to slide 2, we start with a representation of the current portfolio. On the left is a graph showing long-term expected risk and return values from 2018 to 2020. We see a drop of almost 1.5% in expected return and 1% in expected risk, with the 2018 values in the upper right and the 2020 values in the lower left. On the right is the current asset allocation, and we note that the fixed income allocation is 60%, and that during the last few years, the long-term return expectations for certain fixed income securities, i.e. treasuries and mortgages, have dropped to historically low levels, along with interest rates, and this results in the long-term expected rate of return to drop to approximately 4%. Next slide, please. We evaluated the current portfolio and looked at opportunities to improve investment returns, and what we find is that in addition to searching for external expertise, that adding risk may be supported by the longer liability profile, and including private assets and some leverage could be beneficial to improving returns. Next slide, please. When we look at the added value that external management can bring to the long-term care fund, it's multifaceted. Generally speaking, external managers have extensive resources from which they can draw to create and manage customized client solutions. Among those resources are specialized investment professionals and teams, sophisticated technology for investment modeling and risk management, broad market coverage, and industry knowledge. We find that external managers that have experience with insurance funds and long-term care funds have expertise in designing custom asset liability management solutions specific to each client's objectives. They have experience managing insurance-related risks, building liability cash flow matching strategies, and de-risking glide paths in the future. And some have actuarial professionals on staff. These managers can also offer a wide variety of allocation options through broad market access. They routinely structure investments for a wide variety of clients and have experience with managing leverage, sourcing private assets, and managing liquidity for both funds large and small. We could turn to the next slide. Turning to the results of the portfolio review, I will begin with general findings, followed by a detailed review of this slide. The managers all submitted thoughtful and thorough proposals, and we believe that they have strong capabilities and have a good understanding of our objectives. The proposals present a broad range of portfolio asset allocation recommendations, covering more than 30 asset classes and segments across the manager universe. In the proposals, we see wide ranges for allocations to equities and fixed income, a general shift away from treasuries and mortgages into corporate bonds in the fixed income asset class, some private assets recommended, such as private credit, CLOs, and private equity, and some recommended leverage. Evaluating the portfolios in more detail, on slide 5, we show a visual representation of our summary findings for expected risk and return. the goal of the review was to determine what discount rate could be supported. There's quite a lot of information represented here, so I'll step through each component on the graph as well as the methodology used for the analysis. So starting with the 3 gray triangles, there's a point for the current long-term care portfolio for both 2018 and 2020, as we saw on slide 2. And as an additional reference point, the PERF from the 2017 ALM is in the upper right corner with expected risk at 11.4% and expected return at 7%. The blue and orange diagonal lines are trend lines. We evaluated each manager's recommended portfolio using CalPERS 10 and 20-year capital market assumptions from March and plotted each portfolio's specific point on the graph. We then created a trend line for each group, blue for the 10-year and orange for 20-year. And the gray box in the middle is an area in which many of the portfolios cluster, which are all at or above a 5% return and below a recommended upper threshold of risk of 9.5%, which is approximately a 30% increase from when it was last set in 2018. We took the analysis a step further and evaluated the portfolios using Wilshire's September 30 CMAs, which show expected return values have come down from the March values. Our conclusion based on this analysis is that an asset allocation can be selected that is supportive of a discount rate of 4 3/4, given the upper risk threshold of 9.5% and the potential inclusion of private assets and leverage. We could move to the next slide. I'd like to just spend a moment talking about capital market assumptions. And this slide is an updated version of what was presented in the ALM mid-cycle review in June. We know that CMAs are estimated forecasts and that 2020 has introduced more uncertainty than is typical. This is reflected on this chart for each asset class shown by the wide ranges for the March 2020 results, which are the black brackets, compared to the 2017 ranges, which are the orange bars. For our evaluation, we used the median values from March, which are the green dots, and the Wilshire September values, which are the blue dots. And you can see that the Wilshire September values are either at or below our March values. So due to the high level of uncertainty and CMAs coming down somewhat from March, we believe that a discount rate of 4 3/4 can be supported, which is at the lower end of our discount rate evaluation range of 4 3/4 to 5%. We could move to the next slide. This slide shows the anticipated timeline for next steps in the long-term care asset allocation review with the February Investment Committee meeting, and if a manager is selected, a period of time after that meeting for contracting and implementation. And our next slide. So the recommendations before you today are to set the discount rate to 4 3/4, which Scott Tarando, our Chief Actuary, will speak to in a moment. Set an upper threshold of 9.5% risk and add private assets and leverage as available investment options for consideration. And then in the February meeting, as I mentioned, we will be bringing the full asset allocation options and a recommendation for consideration and adoption by the board. At this point, I'll turn it over to Scott to discuss the discount rate.
Thank you, Christine, and good afternoon, board members. Scott Tarando, Chief Actuary. As Christine mentioned earlier in the presentation, our recommendation for the discount rate for long-term care program based on the analysis of the proposed portfolios comes out to be 4.75%. This is higher than the 4% that was talked about in September, but when we compared to the 5.25 discount rate that was used previously, it is still a 50 basis points drop in the discount rate. When you take that into consideration of the change in the discount rate, along with the other changes that were were discussed in September, including the changes to the lapse rate and morbidity assumptions. We are still facing the need to have substantial rate and premium increases for the plan. Based on a 4.75% increase, our recommendation is to allocate the premiums over a 2-year period with a 52% increase on 7/1 of 2021 and a 25% increase a year later on 7/1 2022. The implementation of the rate increase, along with other risk mitigation factors, will be discussed tomorrow at the Pension and Health Benefits Committee. And there will be provided a little bit more insight into some options about voluntary benefit reductions, as well as some mitigations that Don Molds is going to discuss. And with that, I think that concludes the presentation, and we'll open up to questions.
Okay, I'm not seeing any requests for questions, but I do believe we have public comment on item 7A. Mr. Fox?
Yes, Mr. Chair. We have one caller on item 7A. That would be Mr. Tim Behrens from the California State Retirees.
Thank you, Kelly. Vice Chair, members of the committee, Tim Behrens, CSR President. As we mentioned in last week's stakeholders meeting, CSR continues to support any changes to maintain the sustainability of the long-term care plan. I am hopeful that future investments will increase and help to hold down the costs. I receive several calls each month from long-term care stakeholders who are very worried about whether they can continue to pay, and if it goes up 50% in July, I'm going to assume that some of them are going to drop out of the program, and I don't know how much more that will injure the already injured program. So I hope that you can work your magic, Finance Committee. I also would like to say that CSR supports increasing the number of meetings for the Investment Committee during the year 2021. Thank you.
Thank you, Mr. Behrens. Is that the end of the public comment, Mr. Fox?
That concludes public comment on item 7A.
Okay, I have a question from Ms. Brown.
Thank you, Vice Chair Miller. I think my question is for Christine. You know, you're talking about some of these potential investors that have experience, or managers that have experience maybe investing. But you talked about private equity, or you talked about private assets. And so, you know, I assume they're going to, you know, based on models of when they are going to, actuarial models of when they're going to need the cash, they're going to cash flow that all out. And what happens if it's wrong? You know, I mean, the whole reason we're here in this trouble is the actuarial models were wrong. I know they weren't Scots. At least I don't think they were Scots. But you know, the problem with private assets, like real estate, is you got to sell it to get the cash back. And so I just want to make sure that we're going to have the funds to pay for the needed services.
Yes, and what we're seeing with the manager proposals is that the larger blocks of assets are either in equities or in fixed income assets. The private assets that are recommended are typically smaller allocations, just kind of more around the edges than kind of the primary larger asset allocation blocks. So we would incorporate that, and we're going to continue to work closely with the actuarial team and the health team to understand what our liquidity parameters need to be, and so that we're prepared for what might come in the future.
So does CalPERS staff, does like our actuarial staff or our healthcare staff review their assumptions before we allow them to model, or do we review all their models before we allow them to invest, or how does that work exactly?
So the actuarial team and the investment team have been looking at the portfolios, jointly. The managers certainly have their own, models and technology, and we will validate what they are presenting to us through our own assessments. But as we, the next phases in our review is that we will be, talking with and looking more deeply into the proposals and evaluating liquidity and potential liquidity needs down the road is a big factor that we will absolutely consider.
Great. And if our manager guesses wrong, who I assume who pays? The CalPERS doesn't, is that correct? The beneficiaries do.
The two sources of funding are investment returns and premiums. That's correct. I think a lot has to do with what the market will bear. We want to build kind of an all-weather portfolio for the long-term care fund, so that we are planning to add risk, but we want to do that prudently in areas where we believe we will be rewarded for it.
All right, thank you.
You're welcome.
Okay, I have no more questions on the presentation. Thanks for the presentation, Ms. Reese and Mr. Toronto. At this point, I think we need a motion. And that would be in the form of accepting the recommendations for the discount rate for the long-term care, the asset allocation discount rate. Have that correct, Mr. Dungier?
Yes, Mr. Vice Chair. We need a motion on the discount rate, please.
I so move.
Okay, moved by Mr. Fechner, seconded by Mr. Perez. Any further discussion? Looks like, okay, I've got questions from, looks like Henry Jones is next. President Jones?
Thank you, Mr. Vice Chair. My question was answered already. Thank you.
Okay, I've got Mr. Rubalcaba.
No, I can't. I'm okay.
Okay,
can't get it.
Ms. Olivares.
Thank you, Mr. Miller. I have grave concerns about the changes that are proposed for the discount rate and the additional risk our members are being asked to assume. The discount rate that's being proposed for our long-term care insurance exceeds that of the NEIC's stipulated discount rate for long-term care insurance. And extending the assets we invest into riskier assets in order to get high returns, particularly during a downturn in the economy and during a pandemic, creates additional risk. So I am in favor of a much lower discount rate. Thank you.
Okay, any other comments?
I have a comment.
Ms. Brown? I couldn't tell who that was. Okay, Ms. Brown.
Sorry, Ms. Olivares, do you want to make an alternate motion that somebody might second who also is concerned about the high discount rate?
So I could offer a friendly amendment and offer that the discount rate, but this also applies to investment policy, so that the discount rate not exceed 4% for long-term care insurance, but I also would want to keep the asset allocation as is and not extend our investments for long-term care into riskier asset classes.
If that's an alternate motion, I'll second it. I don't think it'll be friendly.
Okay. Okay. And so we have an alternate, well, we have an amendment, an alternate. Is that an amendment to the original motion, or is it an alternate? I'm not quite sure.
The substitute motion.
The substitute motion. Okay. So we would vote on that first to have discussion. So let's have discussion on the alternate motion. One thing I will certainly chime in is I'm really concerned about the impact and the costs and the premiums and the questions I get most from stakeholders are, why wouldn't we be taking the same kind of steps to improve returns that we would in any other fund, and why is this so extraordinarily low? So that's where the pushback comes from my perspective on holding at the status quo, which is making an incredibly painful situation even more painful. Let's see who else I've got. Looks like Matthew Seha.
Thank you, Mr. Vice Chair. Just I wanted to see if can staff respond, I guess, to the alternate or the substitute motion and what that impact would be.
I see Dawn trying to respond.
Yeah.
Dawn, it looks like you're still muted though somehow.
Yeah, we can't hear you, Dawn.
Is that better?
Yes.
Yep.
Okay. I can start, and then maybe Scott or Christine can jump in as well. And we have Vince Bodner here, who has extensive experience in the long-term care insurance market. But Mr. Vice Chair, you're correct that that any reduction in the discount rate increases premium significantly. If you go back to Christine's chart, you'll see that the two lines that she's tracked are based on a 10-year trajectory, and a 20-year trajectory, and the 4 3/4 is safely above the 10-year trajectory. It's worth noting that our anticipated peak of our outflows in the long-term care program are about 20 years off. So there is actually quite a lot of room for longer-term investments, which is what the investment office is advocating for right now. But the flip side of that is that if we are below the 4 3/4, the cost to our long-term care members, the policyholders, go up significantly. If we move back down to a 4% discount rate, the total cost of the premium increase would be about 135%. So it would go up fairly dramatically.
Okay, looks like I have Mr. Rubalcava. You're still on.
I'm having problems. I think I have problems here.
We can hear you.
Can you hear me? Oh, okay.
Yes.
Oh, thank you. Thank you, Vice Chair Miller. No, I was going to say, I think it's been discussed that we all know that we have a challenge, and but decreasing.
You're muted again.
I'm supportive of the initial motion. I'm having problems here. Sorry. I'll pass.
Yeah, Okay, so I have Ms. Olivares again.
Thank you, Mr. Miller. I would like to note that increasing risk does not always increase returns. And so I am very concerned about the cost of long-term care for our policy holders. And I understand that that cost will continue to increase. But I think what is also more important is ensuring that the long-term care program continue and that it be safeguarded. And I think additional exposure to risk actually compromises the plan's safety and will ultimately increase the rates. Thank you.
Okay, I have no more requests to comment or questions that I can see. And so
Mr. Miller,
I will call for the
just
question.
really quickly, I'm sorry,
Sure.
Mr. Miller, sorry to jump in. I just want to make sure that, you know, when you asked about the, about what the motion was on, I said the discount rate. I do want to make sure that we're clear that I believe, and I'll ask, I believe it was Mr. Fechner that made the motion, that the motion is for all three of the recommendations on slide 8. So it's both setting the discount rate to 4.75%, also setting the upper risk threshold for the portfolio at 9.5%, and the inclusion of leverage and private assets in the potential solution sets. Definitely not making a decision that we're going to use them, but just the ability to use leverage and private assets.
My motion was for staff recommendation.
Thank you, Mr. Fechner.
Yeah. Okay, and so that was the original, but right now I think calling for the question on the substitute motion that was made by Ms. Olivares and seconded by Ms. Brown. So call for the question on that. So Ms. Hopper, would you call the roll for the substitute motion?
Margaret Brown.
Aye.
Rob Fechner.
No.
Henry Jones.
No.
Matthew Sehoff or Fiona Marr.
No.
Lisa Middleton.
No.
David Miller.
No.
Stacey Olivares.
Aye.
Elena Ortega.
Aye.
Jason Perez.
Aye.
Ramon Rubalcaba.
No.
Shonda Wesley.
No.
Betty Yee.
No.
Mr. Vice Chair, I have 4 ayes, 8 noes, with the substitute motion made by Stacey Olivares and seconded by Margaret Brown, I believe for no higher than 4%.
Okay, so the motion fails. So we'll go now to call any further discussion before I call for the question on the original motion made by Mr. Fechner. I see a comment from Ms. Ortega.
Thank you, Mr. Chair. I was going to make this comment prior to the other vote, but I think it still stands here that I do.
Sorry, I missed you.
No, that's okay. I do feel a bit like there's some historical similarity to other actions that have been taken on the pension fund side where returns are not, we're not seeing returns that will sustain a program long term, and instead of making fundamental change to the program itself or to the contribution levels, we look at alternative investments. And I agreed very much with the comments that Ms. Olivares made about this issue, and I feel while I absolutely recognize the impact to the participants in the plan today, I can't help but think that what happens a year from now, 2 years from now, if we're really not changing the trajectory of the investment returns, it feels to me a bit of the kicking the can kind of situation. And so that's why I supported the prior motion. Notwithstanding that, I'm happy to see what kind of asset allocation might come to us at the future meeting. But I do feel very nervous about where we are right now with this, and that we're just really delaying the inevitable. And I think that those delays, as the employer participants in the plan on the pension side, they know that those delayed realities are more painful later than they are now. So again, just wanted to make everyone aware of my support for the prior motion. Thank you.
Okay. Mr. Perez, do you have, looks like I've got you in my queue.
Thanks. Does our independent consultant have, can they expand on this a little bit?
Well, so my expertise is in the long-term care insurance industry, and I just, again, many of them are subject to restrictions and regulations that kind of prohibit asset allocation, like what we're looking at here. But I do think that if they did have an option they would consider at least exploring this alternative asset allocation that we're looking at here. I do hear the concerns. I agree that long-term care insurance does have a much deferred benefit while the premiums run down. And so delay in any action is very costly. And so you're right, moving to something riskier could result in a need for a larger increase down the road. But at the same time, I think someone had mentioned the policyholder who is asking why they must pay more premiums now if there's a chance to get a higher return on the assets today. I note that, I would ask Ms. Reese what the view is on interest rates going forward. I mean, is there a view that interest rates will climb going forward from the investment experts that you're working with?
Maybe I'll jump in on that. I mean, candidly, actually, Arnie is probably better to answer questions on rates, but I think our overall perspective is that at rates where they are, we are questioning at the PERF level how much diversification and income. The historical role of fixed income has been income and diversification, and that's certainly something that we're researching as we speak, is whether treasuries being where they are specifically even provide very little income and what they provide in terms of diversification. I don't think we have an actual interest rate forecast. I mean, I do think for a while we thought it was difficult to get them to go down much further. But we do certainly have a question, an open question on how valuable fixed income can be as a diversifier, much less an income producer with rates where they are. Arnie, do you have anything to add to that?
No, not really, Dan. I do think the predicting interest rates is a tough job, but when we do look at what the role of fixed income traditionally is, Dan mentioned diversification and income. Income's not much. Diversification's debatable now. And liquidity, which is important, but we can get liquidity in different types of products or different maturity fixed income exposure. So I do think the same questions we're seeing on this topic do apply to the PERF. They apply to anybody that's got an asset liability framework. It's a tough subject, but predicting interest rates is also a tough science. So I'll just leave it at that.
Okay. I mean, one of the fundamental issues with long-term care insurance is that the duration of the liabilities is so long. It's longer than fixed income assets that you can buy today. And even in the insurance industry, where they have a buy and hold accounting mechanism for their bonds, we're not subject to market value fluctuations like your fund is. The problem is eventually the assets fall short of the liability duration, and you have to reinvest at some point in the future. And I mean, that's really that was really a fundamental problem with the long-term care insurance liability, is that companies bought assets back when they were 6 to 8%, and now they're having to reinvest at assets that are running at 2 and 3% right now on a market value. So there's no real way to completely match that asset liability issue. And right now, with with market values of these assets where they are, if interest rates were to rise, you would see a decrease in the value of your portfolio, of your fixed income. So that's a risk too, that I think you need to think about. And there isn't really a fixed income portfolio that even though your block is older, there really isn't a fixed income portfolio that really matches well with your liabilities going forward. So it's a difficult dilemma. I look at the box that you've drawn on the risk tolerance between the 7 and the 9.5. It seems acceptable. I think it's worth looking at these proposals, and I think doing something prudent, moving to something that does allocate to something with a higher yield, again, is worth considering here.
Okay, any other questions? Oh.
Can I jump in and just add one other thing? Mr. Ortega had raised this issue about sort of long-term sustainability of the program and future costs, and it's an excellent point. Tomorrow at PHBC, I'm going to be talking about an option that we're currently developing that I think is going to be a much better solution to manage costs longer term. But just to be aware that we are looking at that. We have contractual obligations to our long-term care policy holders to continue providing the benefits that are part of their existing policies, but we can offer them options, and I think we will get to a better place where we're able to manage costs better and give them some alternatives, as I'll be talking about tomorrow, that actually can keep them in their homes longer. So long term, that is where we are looking for sustainability rather than increasing the risk that the portfolio is going to take. But this is a piece of the pie as well.
Yeah, that's a good point, Don. And if you'll allow me, that's what the other long-term care insurance entities are doing right now. They're realizing that you can only get so much out of the premium rate increases going forward. They are really focused on the benefits and offering their policyholders meaningful benefits, but that will reduce the liability greatly going forward. And I think that is where a lot of the focus is right now, particularly on trying some of these aging in place efforts as well. That can keep some of the costs down.
Okay, at this point, I don't see any more requests to comment or questions, so I will check and see. Let's see. Okay, so I'll call for the question and ask Ms. Hopper to call the roll.
Margaret Brown. Is she?
Aye.
Rob Fechner?
Aye.
Henry Jones?
Aye.
Matthew Sehoff for Fiona Ma?
Aye.
Lisa Middleton?
Aye.
David Miller?
Aye.
Stacy Oliveris?
Sorry, I want to be clear. I don't think the motion was stated again, but this is to increase it from 4.75 to 9. Sorry, let me pull it up. Can you restate the motion, please? Because I think we're voting on multiple things.
Yeah, the motion was to accept the staff recommendations, which included the increase in the discount rate, included the allocation, included the risk parameters in the presentation.
There was three aspects to the motion. One was setting the discount rate at 4.75%. The second is putting the upper risk threshold for the portfolio at 9.5%.
Between, I'm sorry, between 4.75% and 5%.
No, the recommendation is 5%. I'm sorry, it's 4.75% to set the discount rate at. And then the last one is to have the potential for inclusion of leverage and private assets. And again, the asset allocation will come back in February.
Thank you for clarifying that. My vote is no.
Stacey Oliveris votes no. Elena Ortega.
No.
Jason Perez.
Aye.
Ramon Rubalcaba.
Aye.
Shonda Wesley.
Aye.
Betty Yee.
Aye.
Mr. Vice Chair, I have 10 ayes, 2 noes, one made by Stacey Oliveris, the other by Irena Ortega. Motion was made by Rob Beckner. It was seconded by Jason Perez.
Okay, the ayes have it. The motion passes. Thank you, everybody, for a really thoughtful discussion and decision. So that brings us next to
Henry, or either pointing to God or he has a question.
Henry?
Yeah. No, I was just going to say some time ago, but you've already identified. I was just going to say that the recommendations was on iPad page 196. That's all. And so, but she's someone has already said what they are, but they're there. Okay.
Yeah, thank you. And so that brings us to item 7B, review of the investment committee delegation. And we'll go to Ms. Simpson. And again, congratulations to Ms. Simpson.
Thank you, Mr. Vice Chair. I see Ann Simpson is with us. Jared, if you can also please move, I think you see it happening, Scott, Don Molds, Christine Reese, and James Gunn back to the attendee room. Ann, over to you to take us through the IC delegation.
Trying again. Thank you, Dan. First of all, thank you very much, Vice Chair Miller, for those very kind words. I'm very honored to be in this new role, to serve our members. And thank you to the board members who've sent the same good wishes. I really appreciate that. So this item is to bring back for your consideration a revised investment committee delegation. This reflects some of the discussion that came from the board's most recent self-assessment and the working group, which was looking at how to simplify and make more readable and accessible various board items. And it also reflects discussion in the September meeting around the composition of the investment committee. So just to sum up, there are 3 elements that are new in the board investment delegation which you have before you. The first is to reflect that the investment committee will comprise the entire membership of the board. Secondly, that the investment committee is authorized to act finally with respect to all action which is directed within this delegation. And finally, as has been done with other committee delegations, this version of the delegation removes some duplicative language and sets out the delegation more directly. So with that, Vice Chair Miller, I'd be glad to take any questions.
Okay. Mr. Jones.
Yeah, thank you, Mr. Vice Chair. Yeah, Ms. Simpson, thank you. I just want to be clear, the red line document here are the changes prior to the one we received that was not approved by the committee some time ago. Is that correct?
Let me make sure I understand. The version that you have is intended to reflect all of the direction and decisions that were made previously.
Okay, but there was a presentation made that included some more changes. They're not listed in this change document here.
Correct.
Okay.
Yes, we took that as direction, and our intention is that your direction has been fully reflected in this.
Okay,
that's fine.
Okay, thank you.
Thank you.
Okay, I'm not seeing any other requests. I do have a request from the public, I believe. Mr. Fox?
Yes, Mr. Chair, we have one caller on item 7B, Mr. Tim Behrens from California State Retirees.
Thank you, Kelly. Vice Chair, members of the committee, members of the board. The CSR mission is to protect our pension and healthcare benefits, and we depend on the CalPERS board members to have our back. We support the full board being on the investment committee. It makes perfectly good sense to us to have all of you have our back and support our input and add to the debate for the future. Thank you very much.
Thank you, sir. Okay, and with that, I'm still seeing any others, Mr. Fox?
No, Mr. Chair, that concludes public comment. 7B.
Okay. So at this point, I guess we would entertain a motion.
Yeah, move approval.
Moved by Mr. Jones, seconded by Mr. Fechner. And any further discussion? Okay, Ms. Hopper, I'll ask you to call the roll.
Margaret Brown.
Aye.
Rob Fechner.
Aye.
Henry Jones.
Aye.
Matthew Sehoff for Fiona Ma.
Aye.
Lisa Middleton.
Aye.
David Miller.
Aye.
Stacey Oliveris.
Aye.
Elena Ortega.
Aye.
Jason Perez.
Aye.
Ramon Rubalcaba.
Aye.
Shonda Wesley.
Aye.
Betty Yee.
Aye.
Mr. Vice Chair, I have all ayes for item 7B. Henry Jones making the motion. Rob Fechner seconding it.
Thank you, Ms. Hopper. The motion passes. And so that concludes item 7. So on to item 8, information items, starting with tracking error. And it looks like Mr. Michael Krim with our informational item 8A.
Yes, thank you. Jared, if we can move Ann Simpson back to the attendee area, please. And yes, Michael Krim is joining us. This is responsive to some of the questions that we've gotten around tracking error and kind of the overall risk management framework. So Michael and his team spent quite a bit of time looking at it and thinking through both ways to, to share more information with the board and but also make the whole risk management framework more sort of useful. So with that, Michael, I'll turn it over to you to take us through 8A.
Great. Thank you, Dan. Michael Krim, CalPERS staff. So like Dan mentioned, we have 2 goals for this agenda item. And the first is to just provide a general refresher on the concept of tracking error in response to some board member questions. Tracking error is one of the investment risk metrics that we regularly report and which is widely used in industry. It's also one of the most technical and least intuitive metrics that we have. So we think it's worth carving out some time on occasion to discuss just for those reasons alone. Secondly, there are some inherent challenges with this metric applied to the total plan, which is inhibiting its effectiveness as a risk monitoring and governance tool. We want you to be aware of these challenges. We also wanted to introduce an improved version of the metric, which we've started publishing, that sidesteps these problems. And finally, we'd like to present some ideas for potential future improvements in the investment policy as pertains to tracking error. In terms of how this conversation is organized, I'm going to start with some context on how tracking error, or TE as I'll abbreviate it, fits in our overall policy and risk construct. Then I'm going to touch briefly on the interpretation and the meaning of the metric, but I don't intend to spend a lot of time on the mechanics or statistical aspects. And then next, I'm going to highlight some of the limitations of the metric, particularly as pertains to private asset classes. And then I will close with some of the potential improvements to how we use it. Closely related to the concept of tracking error is the idea of risk budgeting, which is the question basically of how you budget or allocate risk. That includes questions like, what should our tracking error limit be? We're not going to go into this topic today. That is really a broader topic about plan investment strategy more broadly. Today, we would like to establish a common baseline on the measurement and monitoring aspects of this metric. And finally, I want to just start with a point of clarification on the label of tracking error. The word error in the label is potentially misleading. Tracking error is not actually about an error in the sense of a problem where more is worse and less is better. This label kind of exists for historical reasons, and it seems, I think we're kind of stuck with it. But really, tracking error is an investment risk measure. And like any investment risk, whether the risk is good or bad depends on what we get in return for taking that risk, as well as our tolerance that we have for that risk. So with that, I actually want to jump ahead through the materials to, if we could jump to page 4, please. Thank you. So I'm going to start by reading CalPERS investment belief number 9, which states that risk to CalPERS is multifaceted and not fully captured through measures such as volatility or tracking error. Consistent with this investment belief, the tracking error is only one of the many guardrails that are defined in the total fund and program investment policies. We've put a lot of these on this page, not to try to read through them in detail, but to illustrate the fact that tracking error is really part of a broader tapestry of risk tools in use at CalPERS. I think that context is really important because it tells us we are not leaning on this one metric that we're talking about today for our overall investment risk management. Oftentimes, tracking error is either completely ignored by investment professionals because of its many known flaws, or it is over-relied on because it has the promise of summing up kind of everything neatly into a single number. But in the context of a holistic policy framework that we actually have the freedom to avoid either of these extremes and to take from this tool what it is useful for without having to rely on it for the things it's not useful for. So let's go to page 5, please. I'm going to try to explain what is the actual risk that tracking error is trying to measure. Before we get into what it means, I want to talk about what it's trying to measure. And to do that, we have to understand the underlying paradigm that tracking error implicitly assumes, which is that the paradigm is that we could group all investment risk-taking in our plan into 2 broad categories. The first is risk that comes from the strategic asset allocation, which is embodied in our policy benchmark. And then the second category is what we call active risk. And active risk is what tracking error is measuring. Active risk describes how the implemented portfolio is different from the policy benchmark at each point in time. Remember that the policy benchmark is not just a performance yardstick, because I think that's often how we think of benchmarks. The benchmark is also a paper portfolio that specifies a specific set of positions and weights at any point in time. Tracking error attempts to quantify the impact of the differences in the holdings between our portfolio and between the benchmark. So the most important aspect to understand when looking at this metric, when you're consuming it in your oversight, is that it is a relative risk metric. It is about differences between the portfolio and the benchmark. It is not about absolute risk. Said another way, more tracking error means we are more different from the benchmark. It does not mean, more tracking error does not mean that the plan necessarily could lose more money. It might mean that, but it could also mean that we actually have a less risky portfolio in an absolute sense, because we're just trying to quantify how distant we are from the benchmark. Deciding on the strategic asset allocation, that first category, of course, is the most important investment decision we make in the plan, and it is the dominating driver of risk in the portfolio. It is the decision that you review through the upcoming, that you're going to review in the upcoming ALM cycle, and it's a decision that's ultimately taken by the investment committee under advisement of staff and consultants. In contrast, active risk, which again is what we're measuring with tracking error, active risk is driven predominantly by staff's portfolio implementation decisions. Active risk results from two sources. First, there are natural frictions of any portfolio relative to its benchmark, implementation frictions. And then second, there are intentional staff decisions to deviate from the benchmark for return or risk purposes. So under this paradigm, tracking error is a way of measuring and potentially of constraining how much the portfolio implementation deviates from the policy benchmark. And that in turn is kind of the core premise of this metric. The promise, the aspiration is that, that in a single number, tracking error can capture the sum effect of all deviation of the portfolio from the policy benchmark. And in terms of risk management, that implies that as long as you understand the risks of the strategic asset allocation, again, which is the conversation we'll be having in the ALM process, as long as you understand that big bucket of risk, then tracking error can be used in theory to kind of neatly capture the remaining risk of how a portfolio is implemented. And if tracking error remains reasonably small and well understood, then we can feel we have a handle on the overall portfolio risk profile. Now, unfortunately, in real life, tracking error does not work to fulfill this function perfectly. And in particular, it falls short when applied to private assets. So that's why we had the prior slide. We can't rely on it. We shouldn't, but that's the kind of the aspiration of the metric. Can we go to slide 7, please? So just promise this will be brief. The statistical interpretation. Tracking error has an interpretation statistically as the standard deviation of the expected excess of returns of the portfolio versus the benchmark. More simply, I think you can think of this as a measure of how much our excess returns fluctuate, with a higher tracking error implying greater fluctuation in the return of the portfolio versus the policy benchmark, and lower tracking error implying a lower fluctuation. Again, to try to describe it another way, higher tracking error implies a higher probability that the portfolio will either outperform or underperform the benchmark in a given time period. Personally, and there's some problems with the statistical interpretation too. So personally, I actually find it more intuitive and probably reliable to use tracking error not as a predictor of return outcomes, though it kind of has that interpretation, but as a relative measure, almost like you think of maybe a speedometer or the volume dial on your phone, where, you know, if your volume on your phone is set to 4, you may not know what that means in terms of the kind of audio engineering, but you have a sense of what that means based on your experience with that volume level and based on the fact that the manufacturer set your phone up to go to 10. So you get a sort of relative sense of place. So for example, for tracking error, given our tracking error is around 1% right now, and the portfolio benchmark volatility is around 11.5%, you can get a sense that whatever the statistical interpretation, our model, which by the way, both those numbers come from the same model, our model is implying that our excess returns will fluctuate with about 1/10 the magnitude of the overall portfolio. And that actually is pretty close to the historical outcomes as well. Similarly, given a tracking error limit for the plan of 150 basis points, that's our current policy limit, a 100 basis point measured tracking error that we have right now, or 105 basis points, implies that we are about 2/3 of the way to the limit today. So again, just a relative interpretation of the number. Slide 9, please. All right, so let's talk about the problems in the implementation of tracking error. Tracking error is rarely used for private asset classes, and that's for two main reasons. First of all, the metric, like I was discussing, is by definition only meaningful in the context of an investable benchmark. And private asset benchmarks are typically not investable, and ours are not investable. And then the second problem is that data availability challenges limit the effective resolution of the risk model. So what this means is that our model can give us a good, like kind of a rough sense of the economic risk of real assets and private equity that's useful for things like asset allocation, so as overall asset classes. But it lacks the required granularity of data in either in terms of our portfolio positions or in terms of the benchmark and the calibration of the model to be able to convey useful information about relative risk-taking, even if the benchmarks were investable. So those are the challenges with private assets. And on the next page, if we could jump to that, we're going to show how that maps to the total plan. Can we go to page, yeah, thank you. So slide 10. So this chart shows you where the currently reported perf tracking error comes from. And the column on our right is our total reported plan tracking error of 105 basis points. Quick caveat, we did the analysis for this presentation based on earlier data. So it's about 1 or 2 months dated from the data that you had in your quarterly update. But the numbers are very close and the overall picture hasn't changed at all. So, but just in case you were trying to compare those numbers. So if our total tracking error here is 105 basis points, we've broken out kind of where it comes from. And you can see that the tracking error from the private assets, which are the second and third columns in red on this chart, dominate our reported tracking error. And right now, only a small portion of tracking error is coming from our entire public asset portfolio and active asset allocation decisions. And that is that first column in green. Now, by the way, that first column doesn't have to be small. It's been much bigger in the past, but just right now, we aren't taking a lot of active risk in these areas. This portion on the left, this green portion, that's what we call actionable tracking error, because this is where the metric is meaningful and portfolio positioning can be intentionally managed relative to an investable benchmark. In other words, this is where the tracking error metric can map directly and pretty cleanly to portfolio management decisions. For the private assets, we have the challenges I just discussed. So these bars represent the outcome of benchmarking and modeling challenges more than meaningful information about the state of risk-taking in private assets. So let's go to page 11. So there's two implications of having our total plan reported tracking error metric dominated by essentially benchmarking and modeling issues. The first implication is that the metric we're looking at ends up offering little differentiation between vastly different risk-taking scenarios. For the sake of time, I'm not going to go into this table in detail. We can go back to that in the Q&A if you're interested. But the high-level takeaway is that we've modeled 3 very different potential portfolios in this top section. And we see the metric hovering around 100 basis points, almost regardless of what we do across these very different scenarios. So we're not getting a lot of resolution. It's almost like you have a speedometer and it just starts at 55 miles an hour. The second implication of the current implementation of tracking error, because of the modeling challenges in the private assets, is that coupled with our 150 basis point limit, we actually have sort of a de facto intrinsic constraint on increasing our allocation to private assets in the PERF. As we increase our strategic weight to these assets, tracking error will increase relatively quickly exceed the policy limit. And this increase happens mechanistically. It's simply because these assets are almost by definition different from their non-investable benchmarks, and it is not a representation of risk-taking or departure from policy the way that we would want it to interpret tracking error. So these are two implications of the current methodology. And for this reason, we've started reporting a new metric. And if we could jump to the next page, please. And this new metric is on the bottom of this chart. We call this actionable TE. So this table is an excerpt from our regular quarterly reporting, which actually Dan flashed up at the beginning, spoke to at the beginning of the meeting. And we are also planning to introduce this new metric on the Insight tool. And what this does is it corresponds to the actionable tracking error column that I showed you a few pages ago. This metric neutralizes the reported tracking error from privates, which is the one that is creating so much noise in the total tracking error, and allows us to focus on tracking risk-taking in the rest of the portfolio, which I would add is the other 80% of the portfolio, and which is public assets and active allocation. And that is the realm where tracking error can add, I think, some good risk management value. So we're reporting that alongside the old metric, which is the one in the middle of this table. Finally, if you jump to page 13, please. So the last thing we wanted to do in this meeting is raise a few areas of potential improvement to the investment policy language around tracking error. Depending on your feedback, we could work with your consultants to come back with a specific proposal on these topics in the future. And by the way, we have discussed all these materials with them as well as the new metrics. So if you have questions, you can also address them in this meeting. So here's kind of the three areas. First of all, we would consider applying a tracking error policy constraint to actionable tracking error only. In other words, the new metric, with the constraint appropriately resized to reflect the same level of allowable risk. And this would make our risk limit focus on the things where tracking error is we think, a useful metric to measure. The second change would be to introduce language around what happens when the limit is breached, as well as any allowable short-term departures from the limit. For example, for handling rebalancing strategy in a crisis, where you can very easily breach a tracking error limit. And then the third potential change would be to consider dropping the separate 75 basis point tracking error constraint on allocation in favor of a unified limit. We didn't talk about the specifics of the policy on this today, but basically this is a sort of a secondary constraint that we think is less relevant in today's total fund management context. So those are my prepared comments. And with that, I'm going to pause and jump into questions. Thanks.
Okay, thank you for the presentation. And let's see, I have a question from Stacy Olivares. Ms. Olivares.
Thank you, Mr. Miller. And thank you, Mr. Krim. Interesting. I actually love statistics and econometrics, kind of my field. So it's actually an exciting conversation for me. So tracking error, as you know, measures how accurate our predictions are, ultimately. And I understand that the more public the information, the better our prediction, right? Because that way we can have checks and balances on the information that comes in. There's data that's frequently available, and it's more accurate and easy to measure. So I understand why you want to separate these, and it seems like you want to have us look at a tracking error for those that are actionable, so more publicly traded securities, fixed income, et cetera, and then separating that out from private markets, correct?
That's right. And I would say I would pull out. What we want to do, and what we're doing in this new metric is we're pulling out the tracking error that we believe is a meaningful measure, which is essentially neutralizing the privates.
Right. And you're saying that would also cover asset allocation as well?
Right.
So performance
particularly
and
over
allocation.
Excuse me. Yes, that's right. So it would include over and under weights to all of our asset classes, which is obviously a big source of tracking error many times.
Right. And I understand that we've had trouble getting to our private equity allocation. And so I'm wondering how this will affect that. So how the board, for example, can keep track of our allocations to private markets to ensure that we're on track.
Yeah, so the primary channel for measuring our allocation is the quarterly update on performance and risk, as well as the insight tool. And we basically just report the allocation. So you can look at those weights, and that's totally independent of the tracking error calculation.
So then this proposal would just make our TE look lower overall because we're separating out private markets.
Yeah, we would be reporting the tracking error only from these separated items. So we would, could we jump back to page, trying to remember, the one with the bars, page 10. Yeah, so right now the black bar is what we're reporting. public assets and allocations on the left. Again, it's low right now. It hasn't always been low. And during COVID, it jumped to around 90. So it can actually, it's meaningful. It's not just a sort of a throwaway. But the big chunks here are private equity and real assets. And this is not our allocation. We are capturing allocation in that green bar. So if we have big differences, what this is capturing is how private equity is measured by the risk model against its own benchmark.
Right. Okay. Thank you.
Okay, it looks like I have a question from Controller Yee.
Thank you, Mr. Vice Chair. This is really an interesting presentation and really appreciate it. I guess I want to follow on Ms. Oliveira's questions. So I guess on the last slide that was up, slide 13 on the potential policy improvements, yeah. So given that there's a lot of variance between the private equity portfolio returns and the benchmark, so what would we be expecting that staff would still need to report? I guess options 2 and 3 would be preferable, right? To option 1.
I'm sorry, we intended these 3 as all simultaneous changes.
All simultaneous, okay. Okay.
Yeah, but I would say the second and the third are maybe more in the category of cleanup and housekeeping, I think, and it's the first one that I would argue is the more substantive change.
Okay. Oh, I see. Oh, all right. All right. I thought we were looking at them discretely, so I was confused. Okay. So so if we looked at these in total, we still would be able to capture the reporting of total risk. Yeah,
and we would, we would propose to continue reporting the current tracking error metric that includes the private assets. It's just you have to think about the information that you're getting. So right now, our private equity benchmark, and by the way, the issues are similar for real assets. They're just a little more muted. Yeah. But our private equity benchmark is the FTSE. It's public markets. And we have that benchmark, I think, for good reasons. It represents an opportunity cost. It represents a return hurdle. So it's very useful for asset allocation and asset allocation management purposes. But when you're calculating tracking error and you're feeding the risk system, you're giving it all of our private assets, our private equity, and then you're calculating how the risk model thinks private equity is different from public equity. So you have this almost sort of implicit internal inconsistency in that our investment policy for private equity says, well, go invest in private equity. Right. So if we faithfully do that, then we are almost by definition going to have tracking error against the private equity. And there is really not useful information about our management of the portfolio. You're really just getting the risk model's interpretation of how private and public equity are different. And that's why we're saying this isn't something that we want to focus on, because it's just not really useful information.
I see. Okay, that makes sense. And I guess after this discussion today, what should we be expecting with respect to these improvements?
Yeah, so, what we'd like to do is we'd like to make some of these recommendations for policy changes, and really we'd like to work with your consultants on that for both, primarily with Wilshire, but also Makita, and then come with a recommendation at a future meeting. And I'm not sure if that, we would put that, this isn't necessarily an urgent item, but that could be when we revisit total fund policy, or it could be standalone.
Okay.
Maybe I'm sorry.
I'm sorry.
Missy, maybe I'll just jump in really quickly. Sure. As Michael said, what we really wanted to gauge, we recognize the need to spend some time on tracking error and help it, because we've gotten a number of questions over the years. Then when we dug in, we thought, what would actually make it probably more intuitive would be to potentially apply these. But obviously, given, the importance of policy changes, we just wanted to raise this as is this something that there's an appetite for or not an appetite for? Because we are really just interested in feedback. And one of the other points to Michael's previous point that I do want to underscore is that one of the concerns that we have is that there is, and if you go to slide 11, talking about that if, right now, the way it's currently implemented, our tracking error limits would provide a disincentive to allocate to private markets, which of course we know is exactly the opposite of what we're trying to achieve with the investment strategy. So that's one of the reasons to highlight it here also.
Yeah. Okay. Well, Mr. Vice Chair, I would be very interested in pursuing this. I think I like the proposed improvements. I'd like to kind of take a deeper dive in them. And I was just trying to understand the different pieces, but now that they're being proposed to be looked at in total, that makes sense, so that we're still capturing the reporting of the total risk as well. So I would like to see further work on this. Thank you.
Thank you. Next, I have Mr. Jones, President Jones.
Thank you, Mr. Vice Chair. Thank you for the presentation. And each time you make a presentation on track and error, I learn just a little bit more, not a whole lot. But a couple of questions. Given that the change in the relationship to the 150 basis points, if it goes down below that, it indicates less risk, and if it goes up, it indicates more risk. Is that the beginning premise of looking at the 150 basis point tracking error?
Just specifically, more higher tracking error means we are more different from the benchmark. That the implemented portfolio has essentially diverged from the policy benchmark, and less tracking error means less departure. If we theoretically held the benchmark, and again, remember the benchmark is just kind of the systematic implementation of your strategic asset allocation. It's a paper portfolio. If the actual portfolio, we actually just held the benchmark perfectly, which again is impossible, but if we did that, then in theory you would have zero tracking error. That's what the 0 point is supposed to be.
So if we adopt this recommendation to consider dropping part of this, then would the policy of 150 be changed to what, 75, 100?
Exactly. So we would we kind of noodled through it, and we think the allowable equivalent level of risk would be in the public markets and asset allocation that we get today would be around 100 basis points, maybe a little less. And then that's something that we'd want to, so we want to lower the limit to if we wanted to keep the same current risk limit.
Okay. And are there
Again, that's something that we'd want to make sure, you know, we've already walked through this with your consultants, but that's something we'd want to kind of do jointly with them.
Okay. And also, are there ranges like in our asset allocation where we have a target allocation with a plus and minus range? And implementing this policy, I've never seen anything that talked about ranges. Are there any?
No, the wording is a little vague. We actually have it on page 3 of the presentation. And it's the bottom section that's the constraint in bold there. The CalPERS total fund shall be managed with a target forecast annual tracking error of 1.5. So we've interpreted that as a limit. In other words, the limit is 0 to 1.5.
Okay.
But again, you know, I think the language can just be cleaned up a little. And again, like I mentioned in the slide on recommendations, we would propose that we have the sort of provision for, you know, what we call peacetime and wartime, that we have you know, that we think about tracking error as a general tolerance for the staff departing from the benchmarks for the public assets and asset allocation. And then we provision for kind of extreme events.
Okay, well, and as a board oversight tool, we would use the tracking error in conjunction with your targeted allocation. And what else? What other matrices do we use the tracking error with in terms of our oversight responsibility to let us know about your active risk that you're taking? Or is it just this number?
Yeah, no, I would suggest, I think those two are central. I think leverage is important as a sort of a backstop risk metric. And I think, and those are all on insight. Let's see what else comes to mind. I think, you know, the other, in my opinion, one of the most important risk management tools is looking at performance, which obviously we do in a different context, but because a lot of times all these risk models, you know, they tell you what they think could happen. Performance is the cold hard truth. So it's also very important to understand performance.
So this is, so in terms of policy on the tracking error is more of a management tool rather than an oversight tool, then, is what you're saying.
I think it's a good management tool because what happens is if it throws all your, it kind of takes everything in your portfolio like a salad and throws it all in the same bowl and then pops out a single number. And so, kind of theoretically, one of the benefits, and that's, by the way, how we use it internally, is if there's some corner of your portfolio of your, tens of thousands of securities that is kind of doing something different than you expected, tracking error can kind of help give you a little bit of a sense of that. So that's a management approach. As a risk oversight tool, it can give you a kind of a heads up about the level of risk taking, of level of exposure that the portfolio has relative to the benchmark. So I think there it's kind of useful for oversight. And then, of course, again, as a governance tool, you can have a limit, like we do, that puts a boundary on the extent of departures from the benchmark. And by the way, we talked about tracking error and allocation limits, and I mentioned leverage and liquidity. Remember, we also have, like I had on that one page, we have a lot of limits for each individual asset class, and what that asset class can do, and ranges and constraints. So again, it's all part of a matrix of constraints.
Okay. Thank you very much. Appreciate that.
Okay. Looks like I have a question from Director Olivares.
Thank you, Mr. Miller. Just a couple more questions. So one, would it be possible just to have the TE reported overall for the perf and then just have a subsection for actionable TE? And we can just kind of see over time, if we need to keep both. I think that might be an easy solution. And the second question is, I'm wondering if employee performance and compensation is tied to TE.
I'm not sure if I'm allowed to speak to that. It's tied to performance, so no, I think I can answer that. It's not. Tracking error is a forward-looking, what is in the portfolio metric. Compensation is tied to realized returns.
Okay. And it would just be great, to have our consultants take a look into that as well.
Absolutely.
Okay, thank you.
Forecast and tracking error.
Anyone have anything else? I'm not seeing any more. Oh, it looks like President Jones has a question.
Yeah, thank you. Yeah, it may not be a question directly for David, but for Michael, but it's a question that I saw. It raises a question looking at the page 9 where it says real asset benchmark is not investable. And I'm not expecting an answer now, but I know when we had our training on benchmarks about over a year ago, and a question was raised about using non-investable criteria for benchmarks. And so are we moving in the direction of that every benchmark will be investable, or what's the status of that from that discussion?
Maybe I'll
Dan, you want me to take? Okay.
Yeah, no, I can jump in on that one. So yes, Mr. Jones, ideally benchmarks are investable, and that's why in the public markets all of the benchmarks are investable, and we're actually able to replicate those benchmarks. In private markets, that's just a much more difficult thing. In the case of real assets, you have a bunch of buildings and apartments and the like, and it's hard to come up with something that someone can actually just go out and buy the way you can in the public equity space. In private equity, it's arguably you don't even have access to all the same things that would make it investable. But in addition, you can work public equity and put 150 basis points on top of that. And there isn't a product that you can buy that is public equity plus 150 basis points. So in the public markets, the goal is definitely to make benchmarks as investable as they possibly can be. In the private markets, as much as you're trying to make them as investable as possible, it's really, there's just this inherent conflict there.
Okay. Okay, thank you.
Okay, thank you very much for the presentation, Mr. Krim. It doesn't look like I have any more questions or comments. And
thank you.
I think at this point, Mr. Benzino, I think it might be a good time for us to take about a 10-minute break. We've been at it for just about 2 hours straight. So if we would come back, it's on my clock, 3:38. So if we could come back at 3:48, and then we'll jump into the next agenda item. Okay?
Okay, Mr. Vice Chair, we'll see you then.
See y'all in 10 minutes.